Welcome everyone, it's Ruchan once again with Rufaro for Market Views. Welcome to another episode, and today we're going to discuss generally what's been happening in the economy, the Zimbabwean economy, but of course as usual we're going to focus back to the equities market. So in the last, I'd say, month, we're seeing banks giving us their half-year financial statements, and this is something which is quite important regarding the last year. Towards the end of last year, we saw an NPC giving out a capital requirement of 30 million. This is pegged in US dollar but payable in our local currency. And banks have been going in and about trying to comply with this capital requirement. We're seeing consolidation of building societies and many other ways of, I'd say, complying to this. So from what we've seen in the past month and from the trading updates, Rufaro, how do you think, with what the banks have been doing, do you think it's the right thing to do, or do you have anything to add or maybe subtract in ways that banks can comply to this capital requirement, new capital structures?
Okay, thanks, Hilton. So with the core capital, like you rightfully mentioned, it's pegged in hard currency, that is the USD, and it's in ZWL. So ordinarily, you would see most of the bank's balance sheet denominated in local currency, which was the legal currency anyway. So your lending would be in USD if you have assets, money market instruments, investments, they would be in ZWL. But we are seeing a move away from that. Why? Because banks now need to have to comply with the 30 million USD equivalent core capital. So if you look, the official exchange rate is depreciated by over 70% from 1 January up to 30 June, which was the half year. So it means some banks that were compliant end of last year could be in a position where their balance sheet is no longer compliant with the core capital by half year. So we're seeing that switch towards hardening balance sheet. They're doing that by lending in USD. So if you look at CABs, I think they now have about 60% of the loans that they're underwriting in USD. First Capital Bank about 68%. So banks now try to do much of their business in USD so that they harden the balance sheet and they preserve capital. And the other way they can harden balance sheet is to actually buy real assets rather than financial assets that are denominated in local currency. So you see banks getting into real estate, buying land, that kind of thing, so that they remain capital compliant, which also has a risk associated with that, considering that banks, they have their core business, which is lending. That's why you're seeing this USD lending becoming more popular. And the other thing that's also driving that is that lending in local currency really isn't feasible anymore, considering the high interest rates. So there's really not much activity on the local currency front in terms of lending. So in a nutshell, I think that's the sense that you just get moving across the half-year results from the banks. And the other thing that I can just highlight that I found also fascinating moving across the banks is that most banks are profitable, so their bottom line is up. And if you try to look what's causing that, it's not driven by the actual operations. So the bottom line is up because of fair value gains. Okay. So if you have something that is denominated, some real assets, as the ZWL exchange rate moves up, you record exchange. So it's nothing to do with the actual operations, which is lending that the banks are doing. So I can say in a nutshell, that's the sense that I got looking at banks' financial statements.
All right, going over through the lending of banks, I think not only something that's quite outlining the issue of lending in US dollar, we are also seeing that the sectorial lending, most of lending, I'll take a bank like CBZ, it's about 60% of its lending is in the agricultural sector. How do you think this affects the economy at large, and maybe is it a good thing that you are, I think we also always talk about diversification. I think so. Obviously, 60% would be not something that would advise, but is agriculture the right thing? And how do you think this might affect the whole economy at large?
So first of all, I do agree banks play a pivotal role in every economy, in funding, be it agriculture, being it mining or what. Banks play a pivotal role in financing that. But if you are looking at a bank having overweighted towards a certain sector, no matter which sector is it, having 60% of your loan book towards that, it poses a risk on its own. Specifically looking at agriculture, I think, contrary to popular belief, agriculture isn't that significant as we want it to be. You've heard people saying this is an agric economy. But the truth is, if you look at the contributions to GDP in 2019, we did 9.7 contribution towards GDP from agriculture. In 2020, it was up to 10%. So I don't think agriculture contributes that much towards the economy's GDP if you compare with things like trade, production, even mining. You would see that last year we did really well in mining. I think about 60% of our exports came from mining. We did 1.6 in gold. So I think there is scope for banks to really diversify rather than to just overweight towards a certain sector, considering that we had not so good rainfall patterns. So when you have too much exposure in agriculture, it poses that risk. And just looking at the numbers, they're not pleasing, to be quite honest. The default rate, about 25% of people who get loans under the commander are paying back. So those are not quite good numbers. So I think banks need to diversify more and lend towards the other sectors.
All right, thank you. I think now moving on to not just banks, but to the whole economy, I think ideally, as you always say, that the ZSC is a reflection of what's been happening, also of what's really going on the market without any contradictions there. And currently, we are seeing the market, I'd say it has been low. I think the major question you can ask is this what we're expecting at beginning of year as the year started, that at this point in time, the market will be trading at these values, considering, I'd say, the spikes we saw during the year?
The honest truth is no. So take you back to 3 January when the year started. If I had told you that come mid-September, you would be better off having your money just sitting in the bank compared to putting it on the exchange, nobody would have believed that, to be quite honest. And the reason why we're seeing money flowing towards the Zimbabwe Stock Exchange was really a value preservation. So all the gains that we're seeing on the Zimbabwe Stock Exchange was to hedge against inflation. And the ZSE did that quite well 2019, 2020, and 2021. And the half year of 2022, especially the first quarter, did that very well. Come April, I think it was at its highest before these measurements, these exogenous factors started coming through. That year reversed almost everything. So as of today, the YTD of the whole market is now 0.08%. So you are just better off investing, not investing at all. So look, really tough times on the market. I personally think the market is now cheap, but I don't think that's what we expected start of the year.
I think just highlighting just the good part of the market, those who invested in, as you said, 3 January at around 20 April, thereabouts, they gained, obviously, almost every count was way above 100%, which was quite good for those who had invested during that time. So considering to those prices of April, we can now say the market is greatly undervalued. But normally in the past 2-3 years, the years that you clearly mentioned that we're preserving value, that is 2019, 2021, the markets then, the anthem was, our market is overvalued. We are not in $6, $7, $8 billion economy. We should be trading lower to maybe 3 on a good day. And now we are seeing ourselves at the lower parts of 2 sometimes. So I think this greatly highlights that as we go forward, there is obviously room for upside potential. But do you think we're going to get stuck at that 3, or maybe we might go higher back to the 5 billion market cap? Or what is your sentiment in terms of growth? What growth potential do you think is still in the market?
So the upside is there. Look, we're not a $2 billion market, to be quite fair, but it doesn't mean that the market won't stop going down. At one point, I think we got to 1.3, 1.4 billion.
Yes.
I remember sometime in 2018. So it's possible. Well, considering that these valuations are in USD and this is Zim dollar market. So depending on the rate. So with the way I'm seeing the market, the all share was down about 6% today. It was down 7% yesterday. You see those significant decreases. So it's possible we could go down. But look, if we are looking at a company like Econet now selling at 10 cents a piece, that means its market cap is now 200 something million dollars. I don't think Econet is a $200 million company. On a bad day, at least it could be $600-700 million company. But on a good day, that's $1 billion company. Companies like Delta now selling at 2019 a piece. I think there is really upside potential for that. But the problem is people have local currency obligations that they need to satisfy. That's why we are seeing this fire sale on the market, and the market is really in that reversal mode.
All right. Thank you everyone for joining us in this episode. See you next time. Please like, share, and subscribe, and till we meet again.
So nice.